QuickBooks Pro Desktop 2021, rental income, customer deposit, invoiced, and payment. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars homepage. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. We're going to be setting up basically a rental type of process where we're going to rent, instead of like an apartment or something like that, a building or a rental space, we're going to be renting equipment in our case, but the setup and the process will be much the same in that we're going to imagine a situation where someone's going to call us up and say, hey, we want to rent basically this band set that we're going to put up. We're going to rent the band set, which might include like an amp, a couple guitars, possibly some drums. And when they call up and say they want to rent it for a particular day, we're going to say, we would like you to give us a down payment, a deposit, to reserve it for that part of the day. And that down payment will be part of the cost of the equipment that we will charge to the bill or to the invoice when we create it later. So we have this situation where we're going to get paid once again, as we saw in the past, prior to us actually issuing the invoice. And that's a similar process that you would have if you have a renting a building, an office space or something like that, where you would get the money for like the last month's rent or something like that, and you'd have that deposit on hand that you would get before the end or the last month rent before you did anything. You haven't provided anything to them. So we're going to have that recorded first, and then we're imagining a situation where the individual comes in and picks up the equipment. So at that point in time, we're going to say that we have provided what we did at that point in time. It hasn't, the time hasn't ended, but the equipment is out of our hands. It is now in the customer's hands. So at that point in time, I want to record the invoice. As we do that, we'll basically be billing the client at the invoice point, meaning we're going to apply the credit over here or apply the prepayment to the invoice, and the amount that will be still due at that point will be due, and we'll say that's due on the return of the merchandise. And then, of course, the merchandise will be returned at some point, hopefully, and then we will have receive the rest of the payment that was the balance due on the invoice at that point in time. So this is going to be similar to like a rental property, but we'll do it in a shorter period of time, renting basically equipment. So to do this, first off, I want to set up another item for this item to be set up, meaning another item that we'll see in the Create Invoice or Create Sales Receipt. So I'm going to go to the Lists dropdown. We're going to go to the item list. I want to set up a new item, so we're going to go down here in the items dropdown or items rise up, and we're going to go to the new item. I'm going to make it a service item because we're not actually selling the equipment, we're just renting it. The item name, I'm going to say it's going to be band 1 set, so it's going to be a band set 1, or let's say band set number 1. And so that's going to be, we're going to try to group this together in terms of a band set. So we're going to say if someone wants to practice with a mock band set, maybe we have 2 guitars, drums, and amp in basically our mock band set or something like that we would put together in a package deal. Now, if you put it into a package deal, that'll be easier for you to kind of advertise it and group it and be able to know what you're going to put together once you rent out the band set. You could then say that I want to break it out to its components, to like each guitar and set a price for each guitar that you would rent, and so on and so forth. There's pros and cons to that. It might give more flexibility to the people that are renting, but it also makes it a little bit more difficult to record it and then do something that's worthwhile. I mean, you might have someone renting like one guitar, or, one drumstick wouldn't be worth our time really, or anything like that. So we want, if you put a set, like a set together, then oftentimes that's going to be easier to advertise and easier to say, hey, look, that's part of the set. If you don't need 2 guitars, but just one, it is what it is. We have a set price for the 2 guitars, and the price doesn't change. It is what it is, right? There's pros and cons to how much flexibility, but I'm going to say band set 1. Let's say it has 2 guitars, drums, and amp or something like that in it. We're going to say we rent that for basically, let's say, a couple days or the standard time period possibly. And then we're going to say the rate is going to be, let's make the rate $1,500. Is it taxable? We're going to say no because it's a service item. And then with the income account, do we want to record it to sales? It's not guitar lessons. We can group it in. We can't group it to sales because that's inventory. We could put it into service, or we can break it out into its own account. This is, again, a pretty large different segment of income. So maybe we would want to break this out and call it something like equipment rental income, equipment rental, and something like that. It will be an income account. I'm going to say save and close. So that looks good. I'm going to say okay. So there's going to be our item that's going to be set up. So I'm going to close this back out. And then we're going to imagine someone calls us and says, I would like to rent, that band set that you set up. So we're going to rent it for the weekend or whatever it is. Okay, so we're going to say, all right, we need a down payment on it. So we're going to say to reserve the day, we need the down payment. We're going to record it all in the same day. Now I'm going to record the payment that we're getting before the point in time that we have the invoice, because this is the deposit that we've had, and we've seen this in the past, how we're going to account for this. If you want more detail on that, you could take a look back at that customer deposit section. We'll set up a new customer, John Smith, and say tab. We're going to quick add that customer. And I'm going to say that the deposit, let's say it's cash, and we're going to say that we want a deposit. So let's say typically we'll take 10% of the price. So we'll say maybe 1500 times like 10%. So maybe we get 150 of it or something like that. So we'll say 150 down just to lock them into the purchase. We're going to do that on the 28th. So we're going to say this happened basically in the morning. And then we have no invoice to be charging this to because we got paid before we did the invoice. So what's this going to do? It's going to increase undeposited funds, basically the cash account. The other side is going to go to accounts receivable, decrease in accounts receivable, but it's not going to be tied to anything because we got the money before we issued the invoice. So I'm going to say save and close, and let's check that out. It says that there's going to be a credit for this customer, meaning when we make the invoice, we will be able to apply this amount to it. That's what we want. So I'm going to say okay. And let's look at our reports now. Reports drop down, company and financial. Let's take a look at the balance sheet at this point. And we're going to change the dates up top in the customized reports from 01/01/21 to 12/31/21. And let's run that report. So then in the undeposited funds, there's the 150. The other side is going to be going to the accounts receivable, double clicking on the accounts receivable. We see it in there as a negative, decrease in the accounts receivable, but in the detail, there's no invoice to tie it to. Let's close this out and just double check that. We're at 13,323 here. Let's take a look at the subledger, go into the reports drop down, customers and receivables, and take a look at the customer balance detail. So within the customer balance detail, we see this John Smith here has 150, a negative amount, which basically would mean that we owe him, and we do. We owe him that money, or we owe the service that we're going to provide, the rental of the guitar set, right, that he's going to come in and purchase in the future. So again, we have this issue where that's a negative receivable, which is kind of weird because it should be undeposited funds. It should be unearned revenue, a liability. So I won't go through that whole discussion again here, but if you want to take a look at why that is, take a look at the prior presentation when we focused in on just that scenario. But we're going to be moving forward here. We're going to say, okay, let's go back to the home page then. And let's imagine now that person, that happened in the morning, right? Now they're going to actually come in and pick up the equipment, right? So now they're actually going to pick up the equipment. We're going to say at that point in time, we have done the service because they are now using the equipment, and we will invoice. Let's invoice at that point in time. So I'm going to say, okay, now they're picking it up. So we'll set the invoice here and say, okay, so now this is going to be John Smith picking up the information. It's still the same day. We're going to say here, this is all going to happen on the same day. Invoice number 15. Terms, we'll say net 30. And then the item that we're going to have is going to be this new guitar band set that we set up. And there's going to be one band set that we're going to be selling here. So one band set at that 1,500. It's a non-taxable item. So, but we already got some money for it, right? John Smith paid us already. So we need to add the credit. We're going to say, all right, apply the credit. The changes to this, okay, we're going to say okay because it's saving the terms. And say yes. And then there we have it. So here's the credit we're going to apply, the 150 that we got now. So we're going to say done. And we'll say, okay, this is where we stand at this point. We've got the 1,500, 150 has been applied. We have the 1,350 left. What's this going to do when we record it? It's going to be increasing the accounts receivable by the full amount, the 1,500, because we've already recorded in accounts receivable the 150. That negative amount is already there. But the amount that's still due is only the 1,350, because this negative amount, this amount that we applied over, is already recorded in our system. We just hadn't tied it yet to an invoice. That's what we are doing now. And then the other side is going to be going to accounts receivable and then sales, the new sales item we set up based on this, and it knows that by the service item we set up. Let's check that out. We'll say save and close, and then let's go back to the balance sheet, and we'll say balance sheet, and we'll say, okay, now accounts receivable, double clicking on the accounts receivable. We see now the invoice, the 1,500 for the full amount, double clicking on it. We see the full amount recorded, even though they only owe us 1,350, closing this back out. That's because this 150 right above it, that negative 150, is basically tied to it. It's part of the same thing. Closing this back out. If we go to the customer balance detail in the open windows, we see now under John Smith, we got the 1,500 and now the 150. So they owe us, he owes us 1,350. The total down below is going to be the 14,823. That amount should tie out to the balance sheet. If we go back to the balance sheet, we see the 14,823 on the balance sheet. Okay, let's go to the profit and loss. Go into the reports dropdown, company and financial. We'll take a look at the P&L, profit and loss income statement, changing the dates from a 1/01/21 to 12/31/21. And now we have the equipment rental income at the 1,500. New item listed here. Again, we're getting kind of a lot of different segments, but remember, you only want the big segment breakouts between these items up top, and then the more detail in another report, breaking it out by item. So, for example, if we had multiple different equipment rentals, then we don't want another line item for equipment rental band set 1, set 2, set 3, but we might want one set for all equipment rental as opposed to other service items, and then break out the further information in by another report, which would be breaking it out by the items. So there's this. If I double click on that, there is going to be, of course, our invoice. Closing that back out, going back to our home page. So what we've done now is we got a deposit first for less than the full amount, of course, that the rental of the band set. Then they came in and picked up the band set, and we're going to say, all right, there it is. And we recorded the invoice showing how much is due. And now we're going to say that they're going to return the band set. So now once it's been returned, we're going to assume we get a payment at that point in time, getting the rest of the payment. So what would happen? We'd go to receive payment, and we're going to say, all right, now they're going to give us the rest. We got John Smith. We're going to assume it's cash in terms of the payment. Here's the total amount, but here's the amount due that's still due on it. I'm going to check it off. That will then apply it up top, so that looks good. The payment's going to be on this date. We'll keep it no check number because we'll just say it's cash. What's going to happen at this point when we record this? The cash is going to go up, or undeposited funds is going to go up by the remaining balance still outstanding, the 1,350, and then the other side is going to be decreasing the accounts receivable for the amount that's still left outstanding, the 1,350. So we'll say save and close. And let's check that out, go into the balance sheet. And if we go to the accounts receivable, double clicking the accounts receivable, going down to the bottom of that, there's that 1,350, double clicking there, we will then see the customer payment within it. Closing this back out, the other side of that is going to be in undeposited funds. So if we go into the undeposited funds, we now see that 1,350 now, and so that plus the deposit we received earlier is what we currently have in there, which is the full amount of the invoice, the 1,500. Closing that back out, this accounts receivable balance at the 13,473 also matches what will be on the customer balance detail, 13,473. And if we look at John's guitars, John up here, now we had the deposit that came first, then the invoice, which meant that John owed us the 1,350, and then we got that payment upon return of the equipment, we're going to imagine, and that brings the amount back down to zero. So that's going to be the general kind of full process that you can see compact into basically one day that you can imagine. Well, they came in the morning, said they were going to rent the equipment later that day or something like that, right? And then they came in and picked up the equipment where we recorded the invoice, and then they dropped the equipment back off where we collected the rest of the amount due at that point in time. Okay, so let's see where we are at this point. If you're checking your work along with us, here's where we are in terms of the balance sheet. So you can check your numbers with regards to this. We're going to then say this is where we are in terms of the profit and loss. So you can compare your numbers for the profit and loss. And then I'm going to take a look at the trial balance. I think that's the easiest report to use to check your numbers. Accounting and taxes, trial balance. Adjusting the dates up top from 01/01/21 to 12/31/21. Here's what we have in terms of the trial balance.